So in this week's video, I start off with something that I spoke about in the videos or interviews rather that I did last week in the media, and that was the seasonality for Nifty. Now the seasonality for Nifty January is another interesting one. Remember the last time we actually spoke about this subject, it was in the month of July, and the reason was that had one of the best seasonalities at that point of time. It was a lot of green and did eventually result in a 2.9% gain close to the long-term average, and so that ended up being very, very right. Now we are seeing something completely opposite to that in January, which means out of the 10 years at least 7 are negative, which means a 70% strike rate of having a down month, and the average return actually showing 0, because of course when we add all this up, there are a couple of big positive months here that then bring the average back to 0. But that 7 out of 10 months are negative means you could end up with a negative month. So this is sort of how I'm starting into this, and what's really helping this thought process is that sentiment is finally reaching that other extreme, right, where things don't really work out. So that is what we are really paying attention a lot to, which is sentiment. Now, when we actually look at sentiment, we look at one of the things I check is the premium that is really getting paid for rolling over or for the 1 month, 2 month compared to the spot. And that had reached the highest ever on record. I'm looking at the 2 month, even the 1 month was the highest on record, but 2 month is important this week because the 2 month will become the 1 month after expiry on Thursday, right? So it was 243 points on Friday, and today morning in the live market, I saw an exact 200 points in the morning. So you can now check that in the F&O segments of strike itself. You go to the futures segment, you can switch to the 2 month chart. Now the next thing really reaching the opposite extreme is the client side positioning. Every time I show client side positioning, especially I show it along with FI positioning, people come to the realization that client is the smart money and FI is the dumb money. But that's not the way to think about it. Imagine that FIs do, build longs all along the rally, and then when it reaches peak, it simply has the peak position. So that actually is just the herding instinct, right? The herding behavior of the crowd. It has nothing to do with smart or dumb money. In the same way, the herding behavior of the crowd on the client side is they kept buying the dip till they got excessively long at the bottom. So that can be seen in a negative light also. But do remember, the client money is everything, not just retail. I mean, such large positions cannot be taken only by retail investors. Of course, you're counting HNI as retail. You're even counting your operators and large market players, corporates, everything in this segment, because the other segments are just DII and FII, right? So if everything outside DII, FII is in client, then it's actually a much bigger category and equivalent to some of these strong hands or strong money. So in that sense, that is why it appears to be smart in terms of having the largest long or short position near the bottom or the top. So we've ended up with the largest short position since 2017. Now, previous occasions where they were short by 20, 30,000, I think this lower red line I've put at around 50,000 contracts. And now we've actually gone in the last 2 days, we touched 95,000 and it's at 85,000 on Friday when it bounced back. And we really not, 95,000 was a level we'd seen only after or rather before demonetization or a while after demonetization up here in 2017. After that, we've really not seen it go back there. So these red lines represented the range that was there since 2018 to today. But we are sort of attempting to break below it. But the main point being, it is an extreme short position based on recent data. And therefore, it does involve consideration that you're getting some kind of a market high. Whether temporary or more permanent is something we only figure out as we go into the month of January, which, like I'm saying, is a seasonal place to really think about market direction. So that should help us. And at least it tells us that, that the odds of that January cycle playing out are good. What the cycle will mean on the short term, medium term, long term is a completely different question. You can get small correction, you can get big correction. That all depends. Now, so this is the extreme, and we really need to come out of this. In a separate video, I've also discussed something that is the momentum swing, which I shouldn't spend too much time on here, except that it did give us a short-term bounce. The Nifty has still not surpassed the previous high, but it has gone beyond 61% retracement. So that opens up the odds that, okay, maybe we do make a new high into January. Okay, some kind of a pattern can also develop over here. But most probably, if I just go by past behavior, whenever you see the swing diverges when the rally is going on, but whenever it takes that sharp dip to the oversold zone, it's usually the beginning of a corrective phase, and the first bounce more often than not can actually end up being a wave B kind of a setup. So this could be A, this could be B going on, and eventually you end up getting C down. So after this comes out, you do see a drop in the swing, and sometimes if you are getting a wave C bottom, you might even get a positive divergence. Now, whatever I'm saying can be seen. The best part about strike is using, keeping entire historical data. So when I say, oh, this is how it behaves, you can actually go do a back check. Okay, so let's look at this ABC correction that occurred almost a year ago. Between September and October, you had a nice ABC correction. Got this first oversold reading, you saw the swing bounce back, and then you saw it fall, but to a slightly higher bottom at the point where wave C occurred. So this is sort of what I'm telling you. You can go back and check multiple such examples with positive divergences into a bottom. And those are the interesting things. So there's now one more step ahead in terms of how you use the swing. It's only when you start looking at this data every day that you'll find the importance. Very good for short-term picking of lows, highs, and catching the pattern, especially along with wave theory. And we've been using it for more than a decade. So you imagine we've used it long enough to know the importance of it, and therefore having it on this platform. So now directionally what is happening is that you can actually see the open interest based put call ratio peak near the same level. So I put this blue line here. Okay, can make it yellow to make it more bright. Where all the tops have actually occurred during this time frame, right? So whether they are short-term tops or medium-term, irrespective, the put call ratio can sometimes peak even before the price itself, right? So you see it peak here, you get a short-term correction, then it continues higher, or it peaks here, market goes higher, then you actually get a divergence, and then a more time-wise or price-wise correction. But in this case, it just peaked here and that was the top. So each case is different. Now it's peaked here. Okay, somewhere here, prices did make one more new high before pausing. Eventually, will this just continue to decline, or maybe, like I said, you can get a January high with a negative divergence and then sell off. So these are different types of setups that you can actually come across when you actually look at the put call ratio. And lastly, market breadth is also slightly diverging from this recent high against the market. But now any start of a divergence doesn't finally mean that that's the top. So you actually need price confirmation by a break of a trend line, moving average, something along the way. And therefore breadth divergences I don't immediately jump onto. I use them in hindsight, after something has happened, as a confirmation rather than as a forward looking tool. Otherwise you can actually end up in with the wrong idea of what is really going on. But it does help, especially in a very up-down market. You can get extreme overbought and extreme oversold readings like you see here in 2022, marking tops and bottoms. But when you're trending one way, you need to give it some benefit of doubt along with price action before you use a breadth indicator. So all of this on strike, and I've sort of taken you through the key indicators that we are watching right now to understand what the price action is going to be. So before I leave you, I'll just rant a little bit on what the market setup is, because we're actually keeping, if you're a reader of Indiacharts, we're keeping a couple of alternate outcomes open. Some people, when we say alternate outcomes, think you're saying bullish and bearish at the same time, which is not right, because our trend readings are turning to the downside based on a lot of what I've discussed today. So we would expect a down move. What we are not figuring out is whether any correction that follows, will it be a simple ABC in a larger uptrend, or will it be the start of a slightly more deeper or time-based correction? That is an answer we don't have, because there are too many. If I take macro variables to decide that, then there are too many moving parts in different directions that are not giving a clear hint. And if I go by setups, things like sentiment can tell me an extreme is being reached. At the same time, certain momentum data show that there is no reversal, and things are just continuing on the monthly chart along with taking support on the 20-month average, which can be a strong trending indicator as well. So which one should I really pay attention to? So this is one of those points where you're not sure of how to mark the big picture counts in terms of what might happen. You can be slightly coming to the end of a near-term cycle and start attempting to first capture the short-term cycle, and then watch whether the short-term cycle gives you any confirmation signals of the big picture changing. So that is how we are approaching it, and keeping in mind the Jan seasonality that can play an important role in this whole process to figure it out. So we get the final answer maybe only by the end of the month, end of next month, that is, as to how we should, take the bigger markings. But we are not really confused about the near-term outlook. So this sort of presents the case. And if you found these data points interesting, you can find them, track them every day on Strike Analytics with web.strike.money. That's the website. Sign up and get started. Thank you.